Just to give a summary on the lending market, Brian Manning with Guaranteed Rate. Brian is a wonderful lender. I've worked with him for many years. He and I have done hundreds of transactions together, and he continues to exceed expectation and just does a fantastic job. So I'm going to open it up to him to talk about the lending component of the market.
Perfect. Can you all hear me okay? Perfect. Well, Steve, thank you so much for having me. I truly appreciate the opportunity to be here. So I'm in Boulder as well, and I 100% agree with your comments of what you just said about the market there. And one thing I really focus on a lot is just looking forward what's going to happen with the mortgage markets over, say, the next year or so. I mean, we all, or most of us, know that mortgage rates are at historic lows right now, but really looking forward, what is the impact going to be for us, and what's going to change as far as the markets are concerned. So one thing we just pay a lot of close attention to right now is really going to be the Federal Reserve. So as we got into COVID, the Federal Reserve for a second time, the first time was back in 2008, second time being now in COVID, implemented what's called quantitative easing. So it was their bond buying program. So the purpose of doing this was to add stability in the financial markets and keep rates low. So right now, the Federal Reserve's buying $120 billion a month in bonds. That's a combination of mortgage-backed securities and U.S. Treasuries. And their balance sheet right now is really holding trillions of dollars of these bonds. So something we want to pay attention to going forward is just what the Federal Reserve is doing and what their comments are going to be. And eventually they're going to roll into what's called tapering, which means at some point in time they have to slow down and eventually stop this bond buying and let the markets kind of move on more of an open market condition. So we just need to watch what they're going to do here in the near future, and then also what version of tapering will come into play, because this will have an impact of interest rates going forward. And what I mean by that is, if they just announce a tapering of not buying bonds every month, that's probably not going to be very impactful, because right now the Federal Reserve owns really trillions of dollars of mortgage-backed securities. And anytime someone refinances and pays off a mortgage, or sells a home and pays off a mortgage, they're taking that money and reinvesting it back into the markets right now. So if they just taper out of their monthly bond buying, that probably won't be very impactful. But if they taper out of monthly bond buying and they really start a runoff of their balance sheet, that will be slightly impactful on interest rates. So going forward, if you're just paying attention to the news and you hear about the Federal Reserve and really they're tapering, that's something just to pay attention to, because that will have an impact on interest rates. It's kind of ironic we're doing this today, because this morning the ECB, the European Central Bank, who also had a very similar program in place, they just announced this morning that they're going to start their tapering through their bond buying program. So they're kind of the first in suit right now to pave the way across the world for other countries to do this. So the Federal Reserve will meet again at the end of September. I would say it's unlikely that we'll see an announcement at the end of their September meeting in regards to tapering, but probably by the end of the year, we're going to get some feedback there. So I don't think we're going to see any impact on interest rates in the near future, but going into next year, we're probably going to be something. The second item for us to pay attention to is really just the labor force, employment and unemployment. The U.S. economy right now has 11.9 million people that are receiving unemployment. And as of Labor Day weekend, there was 3 additional benefit packages that were available for people that were on unemployment, and those have expired. So you got 11.9 million people right now receiving unemployment across the U.S., and you have 11 million job openings. So we have not seen any of the impact yet from the 3 benefit programs expiring, but it's going to be really interesting to see what happens with new job hirings and unemployment over the next, say, month to 6 months. One of the reasons why I bring this up is because an impact on interest rates is going to be inflation. And something we have to watch for is what's called wage pressure inflation. So a lot of employers right now can't even hire people, right? They're struggling with the ability to hire people. So if you start to see employers needing to raise wages just to entice employees to come back to work, now you get what's called a wage pressure inflation, because as employers, you're having to pay employees more money to come back to work. So if inflation is introduced to the U.S. economy through this version of wage pressure inflation, that's going to have an impact on interest rates as well. So definitely kind of uncharted territory we're in right now, because none of us have ever gone through something like this before. So, certainly what's going to happen with the Federal Reserve and employment over the next 4 months to a year is going to be impactful. So we'll just have to wait and see. With the topic of today being really green building in Boulder, and then probably just around the US, and how we really help improve upon green building. We do have one loan program as well that's very specific. It's an energy efficient mortgage. So this is for a home that has certified presence of solar or geothermal energy solutions. And then this particular program usually gives you about 1/8% lower interest rate. So it's the only loan program I know right now that's very much focused on energy efficiency solutions. So I'm excited because it's really good to see the mortgage industry start to get into this and really kind of get behind the topic of what we're going to talk about today. I would say my final summary on the mortgage markets would be that the Delta variant and COVID are certainly going to be continually impactful on the U.S. economy. So we're going to have to wait and see how that goes. Certainly, I would say we're not in a bubble, and I would really say that for many reasons. So that's going to be a separate topic of conversation. Interest rates are amazing right now, and they're going to continue to be at record lows for quite a long time. And definitely kind of circling back to what Steve said before, interest rates and qualifying are not holding back buyers right now. It's low inventory. Even for myself as a lender looking at buyers that are purchasing in Boulder in the Front Range market, that it's not qualifying, it's not interest rates, it's the availability or the lack of availability of homes for sale that are probably holding us back right now. That's the quick update on the mortgage markets, and thank you again for having me.
Thanks, Brian. That's amazing. Every time I do this, I learn something, and it's clear your vast depth of knowledge. It's interesting, one of the things I've often said is within reason, moderate rising of interest rates can actually help the real estate market. And I don't know if you've seen that, Brian, but it almost acts as a stimulus because buyers feel like they need to secure their rate, make their purchase decision now before rates continue to go up. And in a declining market, buyers are often wanting or willing to wait. But with a little bit of upward pressure, that could actually stimulate our market to an extent until it gets out of control.
I would agree. And then you're still going to contend with the low inventory. So even when the pressure is there, I agree with what you said before, that pushing into spring 2022 is going to be a market like we're experiencing right now for everything you just outlined.
Yeah. That's great. Thank you, Brian.
You're welcome. Thank you.
Great summary.